Damn.
You have some money sitting in your bank account. You want to invest it. You pull up the market and it looks like prices are dropping. And that little voice in your head says, wait for it to drop more. Buy at the absolute bottom. Get the best deal possible. Sound familiar? Millions of investors do exactly this every single day. And almost all of them end up worse off than the person who just kept buying quietly every month without overthinking it. So which one is actually the smarter move? Are you better off timing your purchases around market drops, or just putting in a fixed amount every month no matter what? Two of the most talked about investing strategies in personal finance go head to head on exactly this question. And the answer, backed by over a century of real market data, might surprise you. Let's start with dollar cost averaging, or DCA. The idea is almost embarrassingly simple. You pick a fixed dollar amount, say $200 a month. You invest that exact amount on the same day every month, whether the market is up, down, or sideways. You don't check predictions. You don't read headlines. You don't wait for the right moment. You just buy. The brilliant mechanical thing that happens here is this. When prices drop, your fixed $200 automatically buys you more shares. When prices go up, that same $200 buys you fewer. Over time, this natural rhythm means your average cost per share smooths out. You avoid the nightmare scenario of dumping your entire savings into the market the day before a big crash. Now, meet Alex. Alex earns a decent salary and has $12,000 saved up. Alex decides to invest $1,000 every single month for a year into an index fund. No matter what, Alex does not watch financial news. Alex does not check what the market did today. January through December, $1,000 goes in on the first of the month. Done. Now compare Alex to Jamie. Jamie also has $12,000, but Jamie is convinced there's a smarter way to play this. Jamie parks the whole $12,000 in a savings account. The plan is to wait. Wait for prices to fall by 10%, then pounce. Buy at the discount. Profit. This is buying the dip. And on paper, it sounds like genius. You're being patient, disciplined, strategic. You're waiting for a sale before you shop. What's not to love? Quite a lot, as it turns out. The math starts working against Jamie from day one. See, the stock market does not actually spend most of its time falling. It spends most of its time either rising or sitting right near its all-time high. According to data on the S&P 500, between 1995 and 2018, the index was setting a brand new all-time high in over 50% of all trading months. More than half the time, prices were not on sale at all. They were at record levels. So while Jamie sits in cash, waiting for a dip that may not show up for months or even years, Alex's money is already in the market, compounding, growing, working. That lost growth has a name in finance. It's called cash drag. Every day, your money sits in a bank account instead of the market. It's missing out on the long-run return that equities historically provide. That's not dramatic speculation, it's just math. Stocks have beaten cash roughly 76% of the time in the United States over multi-decade periods, according to Vanguard's research spanning nearly half a century of market history. Now, Jamie, being optimistic, thinks, fine, but when the dip does come, I'll more than make up for it. And this is where a fascinating experiment comes in. A portfolio manager and data scientist named Nick Maggiulli ran one of the most memorable tests in personal finance. He called it God versus the Savings Plan. Here's the setup. One investor, we'll call them the regular saver, puts $100 into the stock market every single month without fail across a 40-year period. That's it. The second investor, the omniscient dip buyer, is given an impossible superpower. They know, with 100% certainty, the exact lowest point of every single market crash before it happens. Not close to the bottom, the actual bottom, the mathematical floor, and they have been patiently saving their $100 per month in cash, deploying the whole pile at the perfect moment every single time. You'd expect God Investor to absolutely demolish regular saver, right? Buying at every single low. How could that possibly lose? It lost. In 70% of all rolling 40-year windows going back to 1920, the regular saver, who just kept investing every month outright, beat the investor, who timed every single dip to perfection. 70%. Think about that. Even a strategy requiring literal omniscience failed to beat boring, automatic monthly investing most of the time. Why? Because while God Investor was accumulating cash between crashes, waiting for the next perfect bottom, all of that money was earning almost nothing, and markets were climbing. By the time the crash arrived and God Investor finally deployed, the discounted price was often still higher than the prices regular saver had been buying at years earlier. So DCA clears a genuinely high bar. But what about real investors without superpowers? What happens to a regular person who tries to time the dip on instinct? March 2020, COVID-19 sends the stock market into freefall. The S&P 500 drops roughly 34% in just a few weeks. For any buy-the-dip investor who had been waiting patiently for years, this was the moment. The textbook scenario, a genuine catastrophic sale, and almost none of them bought. According to behavioral data tracked during that period, the vast majority of retail investors didn't load up on cheap stocks in March 2020. They panicked and sold what they already owned. The S&P 500 went on to roughly double over the next 18 months. The people who held and kept buying were richly rewarded. The people waiting for the dip either missed it entirely or fled at exactly the wrong moment. This isn't a character flaw, it's just how human brains work. When prices are falling 34% in weeks, when the news is genuinely terrifying, when real people are losing jobs, a part of your brain does not see a sale. It sees danger, and it wants to run. A Nobel Prize-winning framework called prospect theory, developed by psychologists Daniel Kahneman and Amos Tversky, explains this precisely. Humans experience the pain of financial loss about twice as intensely as the pleasure of an equivalent gain. So when a market is crashing and your money is disappearing, the emotional toll is so overwhelming that rational math goes out the window. This is why buying the dip destroys so much real-world wealth. The strategy requires you to execute a purchase at the exact moment your brain is screaming at you to do the opposite. And the data on professional, systematic dip buying is just as grim. QR Capital Management, one of the most respected quantitative investment firms in the world, published a study called Hold the Dip. Their researchers tested 196 different versions of a buy-the-dip strategy using S&P 500 data from January 1965 to September 2025. They tested every combination of dip size, 5%, 10%, 15%, 20% drops, paired with different holding periods. Every single permutation underperformed just holding the market passively. In the most recent 35-year window from 1989 to 2025, the risk-adjusted return of dip buying strategies degraded by roughly 47% compared to simply owning the index. Across all 196 versions tested, the average extra return generated by waiting for dips was a measly 0.5% per year, not worth the years of lost compounding. Charles Schwab ran a separate study asking a simpler question. Over 20 years, who ends up richer? The investor who times the market perfectly every year, the investor who invests immediately as a lump sum, or the investor who holds cash waiting for the right time? The person holding cash, waiting for the perfect dip, ended up with $103,986 less than the investor with the absolute worst timing in history. The investor who somehow managed to invest at the exact market peak every single year for 20 years straight. Even the most spectacularly unlucky investor beat the cash hoarder. So where does this leave us? Lump sum investing. Putting everything in at once is mathematically the best strategy when you have a windfall. Vanguard's research across global markets from 1976 to 2022 showed it beats dollar cost averaging about 68% of the time over a one-year horizon. Get the money in the market as fast as possible and let compounding do its work. But here's the thing, most people don't have a windfall sitting around. Most people are regular investors, getting paid every 2 weeks, and putting a piece of that paycheck away, and what they're actually doing, without realizing it, is already mathematically superior to traditional DCA. There is a common misconception in the personal finance world that investing a portion of your paycheck every month is dollar cost averaging. Technically, it isn't. True, DCA means you have a lump sum of money sitting there, and you are deliberately holding it back, spacing out its entry into the market. When you invest the moment your paycheck arrives, you are just doing the smart thing, getting 100% of your available money into the market at the earliest possible moment. That's actually closer to lump sum investing on a micro scale. every paycheck is its own lump sum, deployed immediately. And that matters, because it means regular paycheck investors are not sacrificing compounding returns by holding back cash. Their money goes in as fast as they earn it. Now, for those of you sitting on a meaningful lump sum, an inheritance, a bonus, or savings you've accumulated, and the idea of investing it all at once terrifies you, there is a middle ground worth knowing about. Researchers have developed what's sometimes called enhanced dollar cost averaging. The idea is this: you take your lump sum and plan to invest it over a set period, say 12 months, but you add a rule. Any month the market drops by a certain threshold, say 5%, you double your scheduled contribution that month. For example, if you plan to invest $10,000 a month from a $120,000 windfall, and the market drops 5% in March, you invest $20,000 in March. This way, you capture some of the dip buying upside while keeping your money steadily entering the market rather than sitting idle in cash for years. The bottom line on buying the dip is this: it's not a bad instinct. It comes from a genuinely reasonable place. Who wouldn't want to buy things at a discount? The problem is the market rarely gives you the kind of discount that justifies the years of lost growth sitting on the sidelines. And when it finally does, the psychological environment makes it nearly impossible for most people to actually execute. If you're waiting for the right time to get into the market, that time costs you money today, and it will cost you more tomorrow. The research is clear on this across over a century of market history. Time in the market consistently, persistently outperforms timing the market. If you take one thing away from this video, make it this: the single most powerful investment habit you can build is automating your contributions and removing decisions from the process. Set it up so a portion of every paycheck goes into an index fund the day it arrives. No watching charts, no waiting, no second guessing. That simple system, repeated consistently over years, beats almost everything. If you found this useful, hit the like button and subscribe so you catch our next video. And drop a comment below. Are you a DCA investor, or have you been waiting for the perfect dip? We'd love to know.